Welcome. So let's jump right into the latest weekly mortgage report. Now, I know what you're thinking. These reports can be a little dry, but trust me, this week's numbers tell a really wild and honestly pretty counterintuitive story about what's happening in the housing market. There's a genuine puzzle hidden in this data.
So here's how we're going to break this all down. First, we'll look at that surprising spike in demand. Then we'll tackle the interest rate puzzle that it creates. After that, we're going to unpack the why, look at how the loan landscape is shifting, and finally zoom out to see what this whole thing tells us. Okay, let's get straight to the big headline. This week, the total volume of mortgage applications went up. It's that simple. More people are raising their hands and saying, yep, I want to buy a home. But here's the part that makes you go, huh. Applications to buy a home went up at the exact same time that mortgage rates, the cost of borrowing money, also went up. Normally, you'd expect the opposite, right? It gets more expensive, demand goes down. But not this week. And that is our central puzzle.
So if you look at the big overall number, the market composite index, which is just a fancy way of saying all mortgage applications together, it saw a really solid 3.2% jump from just the week before.
But check this out. When you dig into that number, the story gets even clearer. That increase was almost entirely driven by people looking to actually buy a home. Applications for new purchases skyrocketed by a massive 7.8%. And just so you know, this isn't some tiny little weekly blip. It means purchase demand is running a full 11% higher than it was at this exact same time last year. That signals a real, serious strengthening in buyer interest. Okay, so that's one half of the puzzle, right? The demand is up. Now let's flip it over and look at the other half, the cost. How much more expensive did it actually get? And this brings us back to that core question. Why on earth would more people be buying when the price of admission just went up? I mean, just look at these numbers. The average rate for your standard 30-year fixed mortgage climbed up to 6.19%. And rates for those bigger jumbo loans, they went right up with it. No doubt about it, borrowing got more expensive.
Now, these rates didn't just go up for no reason. They're not happening in a vacuum, right? The source material makes it really clear they are a direct reaction to all the volatility out there in the wider world economy. When global markets get nervous, it often pushes our borrowing costs higher here at home. So we've got rising demand and rising costs happening at the same time. What gives? How do we explain this contradiction? Well, the experts have a few key ideas. To figure this out, let's turn to the experts. The chief economist over at the Mortgage Bankers Association, Mike Fratantoni, he points to that market volatility we just talked about, but he also helps us understand why buyers are jumping in anyway. And it turns out, it's not just one thing. It's kind of like a perfect storm of a few different factors. First, there's this lingering effect. See, the week before, rates had briefly dipped, and that basically opened the floodgates for a ton of buyers who were just waiting on the sidelines. Second, in some parts of the country, there are simply more homes for sale, which gives those eager buyers more to choose from. It all points to this huge pool of underlying demand that's just ready to pounce on any little window of opportunity. All right, so I think we've cracked the main mystery here, but let's dig a little deeper, because it's not just about how many people are applying, but also what kind of loans they're going for. And that's changing in some pretty important ways. So first, let's talk refinancing. And you can probably guess this one, right? With rates going up, it just doesn't make a lot of sense for most homeowners to trade in their current mortgage for a new, more expensive one. So no surprise, its share of the market is shrinking. And this chart just lays it all out perfectly. Look at that slice of the pie for refinances. It got smaller, dropping to just under 58% of all activity. And that means new home purchases are really starting to carry more of the market's weight. We're also seeing some interesting moves in those government-backed loans. And this is kind of cool. The share of FHA loans, which are super popular with first-time homebuyers, actually went up. This might be a sign that more of those first-timers are finding a way to get into the market, even with these higher rates. And one last little shift to point out, adjustable rate mortgages, or ARMs. Their share of applications ticked up too. This suggests that some buyers are kind of thinking outside the box, looking for alternatives to those higher fixed rates, even if it means taking on a different kind of risk down the road. Okay, so we've looked at all these different pieces of the puzzle. Let's step back and ask the big question. What does it all mean? What's the big picture takeaway from this week's data? This report really paints a picture of a housing market that's, well, it's complicated and, frankly, a bit contradictory. It's definitely volatile, with rates bouncing all over the place.
It's uncertain, which makes it really hard to predict what's coming next. But, and this is the most important part, it's also resilient. Buyer demand is holding up way better than you might expect with all these headwinds. And hey, just to show you how volatile and fast-moving things are, it's worth pointing out that different data sources can show you slightly different things. For instance, while the MBA's big survey showed 6.19%, another tracker that looks at actual rate locks showed an average of 6.06%. It just highlights how quickly things are changing day to day. And that really leaves us with the million-dollar question, doesn't it? The one everyone in the housing world is asking right now. Is this surprising strength we're seeing from buyers the start of a new, more resilient trend? Or is it just a temporary blip in a really volatile market? That's what we'll all be watching in the weeks ahead. Thanks for joining this explainer.